Dealing with high interest rates. This is presented by Anchor Consulting and Capital. My name is Andrew Seeker. Just a quick disclaimer before we get started and jump in. Anchor Consulting and Capital does not provide legal or tax advice. This material is not a substitute for seeking the advice of a qualified professional for your individual situation. This material is for general information and educational purposes only. The information is based on gathered data from what we believe are reliable sources. However, we cannot guarantee this to be accurate or timely, and we do not purport to be complete, and it is not intended to be used as a primary basis for making investment decisions. It should also not be construed as advice, legal advice, meeting the particular investment needs of any investor. And again, we highly suggest that you please consult your tax or legal professional. Anchor Consulting and Capital will not be held liable for any misinformation or any loss to any investor or any person that took action on this advice in this video and lost money. Okay, let's dive in. Is interest paid on investment property tax deductible? Well, the answer is it depends. Yeah, nice, you say. If you do a search on mortgage interest deductions on commercial property, you may find various answers. The Internal Revenue Service, the IRS, answers this question in their publication 527 and 535. So I've done a little bit of diving into these publications for you, and here's a little summary of what was said. Okay, so publication 527 basically says that categorically that you can deduct mortgage interest expenses you pay on your rental property. However, before you get too excited, the document does provide some caveats when it comes to refinancing. Specifically, if you decide to refinance your property for more than you previously paid for it or the outstanding balance, then the portion of the interest that can be allocated to the loan proceeds not related to the rental use cannot be deducted as a rental expense. So basically what this means is that if you were to refinance and the loan amount is now higher than your original mortgage, then the interest rate difference is not tax deductible. So let me give you a quick example. Let's say you purchase an income property at $400,000 and 2 years later you refinance it and you're able to pull out $500,000. That interest that's accrued on the difference of $100,000, that's the difference between the $400,000 and the $500,000, would not be tax deductible. That's even if you got this cash out refi for upgrades to improve or renovate your property. They just consider that a capital expense and you're going to get taxed on that interest rate, or the interest rate will not be tax deductible. Excuse me, I stand corrected. Okay, publication 535 goes a little bit more into detail about mortgage interest rates and deductions, and they state the following here. In most cases, mortgage interest paid or accrued on owned real estate is deductible, but rather than deducting the interest currently, you might have to add it to the property's cost basis in a process known as capitalization of interest. And I'm not going to get into that in this video. I think I'll let your tax professional explain that to you. Capitalization of interest is used in the production of real property. In other words, this would be used if you're building it from the ground up, or in some cases decide to gut and renovate a property. Also be aware, if you pay off your mortgage early and end up paying your lender a penalty, that penalty can be deducted as interest, believe it or not. Okay, so what is not considered deductible? Well, expenses paid to obtain the real estate mortgage in the first place, your original and first mortgage, specifically mortgage commissions, abstract fees, reporting fees, credit reports, title and escrow fees, prepaid insurance, prepaid tax, realtor fees, broker fees, and the like cannot be deducted as interest because this is considered capital expenses. Excuse me. Okay, so now what? What's the purpose of this video if you can't deduct all this, or if it's kind of vague and we're not sure? Well, I just want to present some ideas here. One idea is that we have for real estate investors is to obtain your target property, even if the rates are higher than they've been in the past couple years. So right now, as I'm creating this video, we're looking at 7 to 10% plus interest, depending on the type of loan, of course, whether you're getting conventional or private money. Um, but anyway, if I'll talk more about this in just a minute, but you can breathe a little bit easier knowing that you can get that interest rate deducted from your taxes. Okay. There's a second little caveat here, and that is you refinance the property into a lower interest rate when the rates drop. So in the meantime, while the rates are high and you're in the original loan at the higher interest rate, then you go ahead and deduct the taxes. You can still, of course, deduct taxes when you get into a lower rate. However, obviously the deduction is not going to be quite as significant, right? But it all comes out in the end in the wash, I believe. Okay, so here's some other ideas to think about. Don't forget that you should be able to deduct the interest expense on your tax returns, okay, as stated. This should help alleviate some of the expenses paid on that property, okay? So you're just getting money back from the IRS at a later date. Do a thorough due diligence and property analysis before acquiring the property. You want to make sure that the property will cash flow before you acquire it, okay? And you want to make sure that this property's cash flow, the net operating income, and everything that's generated from the property can service the debt. This is crucial, and you must get this right before you get into this property, any property that you want to acquire. If you want to be cash flow positive, use the highest current interest rate and factor that into your debt service. In other words, if the highest rate is currently 9%, then use 9% to figure out what your mortgage payments are going to be every month and annually, right? And of course, you will factor this in after you have calculated your net operating income. So the formula is you have your gross income, then you take out your vacancy, and then add in any auxiliary income like from vending machines or laundry, coin-op laundry machines or what have you, and then you come up with your gross income, right, or your net income, and then I'm sorry, your net, your gross income, and then you take out all your expenses, and then you come out with your net operating income. And from there, once you have your net income, then you take out your mortgage expenses, your principal and interest. Okay. So you want to make sure you get that right. And then consider appreciation too. So while you're holding this property, if you plan on selling it in say 5 years and all goes well, then your property should have appreciated. So you're going to capture some of that money back. And that along with a refi, if the rates do go down and you decide to refinance into a lower rate, then you should be just fine, right? Because you've got the lower interest rate, you've got increased rents, I think, over time, right? You're probably going to want to raise the rents over the 5 years. That will help the property's value go up. So will appreciation. Any type of, what do you call it, renovations or remodeling of kitchens, bathrooms, all these things can add value to the property while you're waiting for the interest rate to go down. Meanwhile, we're patiently waiting for the rates to go down, and then at the opportune time, you can go ahead and refinance. Okay, so anyway, I just hope these ideas, I hope some of these thoughts and ideas are helpful for you. I just want to thank you for your time and attention here. And once again, be sure to consult your tax or legal professional for advice. I've just shared some ideas with you to consider. Again, I can't claim that this will work for you. It may not. I hope it does. And lastly, if you have any questions or comments, I would love to hear from you. I'm always learning myself and open to learning. So if you have anything to say, please contact me. My information's there. I'm happy to learn, happy to discuss and see, if there's anything I did wrong, I'd like to know. All right, that's it. I'm out of here. Thank you again.